Welcome to TheoTrade. This is Don Kaufman. Tuesday, June 21st, 2022. An absolutely ripping, possibly quintessential bear market rally. I say, bring back the bears. So with the S&Ps up some 2.7%. First question you got to ask is the rally sustainable really to any degree? And one of the things that I want to point out just right off the bat, I always look at markets like this, when we get these again, this, bear market rally, and that's all that we're calling it for the time being. Of course, it could turn into something bigger, something spectacular to the upside. Nevertheless, I like to look at markets like this and kind of say like, hey, what's wrong with this picture? And you look down the list, some of the usual suspects, like, okay, S&Ps are up 100, and Nasdaq's cooking over there. It's also doing really well, although there is there was breaking news out of Meta, formerly the artist known as Facebook, but Meta actually comes out with a settlement, and the stock has had a precipitous slide, another 4%. Man, they just can't catch a break. And that's actually cooling off the NASDAQ to some degree. Anyway, you look down the list, some of the usual suspects. What's the big standout? And if you're, any degree of experience, you're going to pick up on it immediately. I don't care whether you're looking at VIX, right? So you're looking at the VIX and you're like, what happened to the VIX? Absolutely nothing. It didn't collapse. What happened with the volatility futures? Volatility futures are finishing the day flat. In fact, they've actually been rallying. That doesn't feel right. And when I say, bring back the bear, well, this is indicative, again, then of a absolutely a little bit of more of a bear market rally. I mean, what the volatility futures are effectively saying, and volatility in general, okay, it's a rally, but we don't buy it. At this point, the rally is probably in predominantly short covering. Like nobody's running out right now and they're like, oh yeah, man, got to buy me some of that Apple. It's tough. I mean, people are incredibly skeptical at this point. If you don't believe me, look at the volume. Now, I just want to point out that volume in the S&Ps, which is almost 1.4. You're like, oh, that's high. Yeah, except that included Sunday night when we reopened. It included most of Monday, so the futures contract's still open Monday, and then it included today. So overall, what's the volume? It's really bad, really low. And it's one of the things that you got to kind of focus on. So at this point in time, nothing more than a bear market rally, and you should treat it as such. I mean, that's the sum of the pieces in here. In fact, when you look at the volatility with 4 minutes left to play in the period, we're still actually in a very, albeit very mild backwardation. That is, the 29-day volatility futures are trading 30.15, which are over the 57-day, which is, again, still rather intense volatility is what the marketplace is denoting. One of the things I was pointing out on Friday is something I'll also point out today, the energy sector. Follow it and follow it closely, because when the energy sector lately is moving, this is a 5% move. I mean, the moves have been absolutely extraordinary in the energy sector. You can't discount them. I mean, the S&Ps right from the get-go this morning, I mean, energy was up and sustained the marketplace. There's only a glimmer of the energy sector backing off, but you got to watch it in a day like this where the marketplace is rallying, because it's tough to have a wicked reversal on an intraday basis when energy is this strong. And again, a lot of people discount energy. You shouldn't, because the energy sector itself now is filled with mega market caps. This is not what it was a year ago. I mean, some of the generals have actually fallen, and there's a new general in town, if you will. The energy sector is actually up there with ExxonMobil and Chevron and ConocoPhillips. I mean, again, there's some heavyweights in terms of market capitalization. Nevertheless, the marketplace is proven me accurate here into the close of some sell side activity, and it's far from over. So there's one other aspect that I wanted to talk about tonight is you can see again, it doesn't matter what you think about S&Ps at this point. We're in the midst of volatility. And one thing that is of critical importance, and to really understand volatility, okay, stop trying to handicap what you think is going to happen on a day-to-day basis. At this point, it's always about risk reward. It's about looking at volatility and making some assumptions of the forward future. It's about looking at things like bonds and recognizing like, ruh-roh, the bonds are actually, turning south again. I'm not sure that's going to be good for the marketplace. If those bonds continue to break down, you better believe they're going to come for tech again and start to sell tech. There's a lot of problems with this marketplace, and none of the problems have been resolved. Now, it's not to say could we actually rally tomorrow? Again, we've got some headwinds for us later this week because you're going to hear from the likes of none other than Jerome Powell, that is, as there's going to be testimony both tomorrow and Thursday, some prepared statements coming out tomorrow. They may be a little hostile to the marketplace. Speaking of hostile to the marketplace, the advanced decline line is pegged today. This is a high correlation, which is indicative of the entire market. It's trading as one unit, which doesn't necessarily bode well. It's still, it's one of the hallmarks, if you will, of volatility in a bear market rally is, well, we're totally and completely correlated. All right, so moving on over here, there's one other area that I think is critically important to kind of understand outside of bonds, outside volatility. You look at the VVIX till we're blue in the face here, but one other thing that's really, I think, bothersome at this point, if you take a look at the SPX, 50 seconds left inside of the trading session, if you take a look at the SPX, the mother of all products, you've got three recent breaches of expected move. It's not the fact that we breached the expected move that's on my mind. It's the fact that that's a 2 sigma move. That's a 2 sigma move. That is almost a 2 sigma move. Okay. What I am saying by this is, we can look back at a huge amount of data, and I've got years and years of data, even into this COVID crash, okay, which was one of the more hostile times. That's 5 sigma move. And one of the things that's really bothersome at this point in time is not the number of breaches in the expected move, it's the magnitude of the breaches. And there's the closing bell. It's the magnitude of the breaches in terms of expected move. One of the things that we've tracked is these breaches, okay? The breaches of expected move often lead to, well, more breaches of expected move. But the question mark right now is, how can the SPX be getting it so wrong? It almost looks and feels, and it really is a very quantitative aspect in here that I'm going to get to, but the marketplace is getting it wrong. In terms of the SPX, volatility feels suppressed, if you will. And what it tells me is there's probably an alarming number of traders presently selling premium, and it looks like they're doing it in the very short duration. Okay, so what's wrong with that? Well, if you're selling premium in the short duration, and instead of moving, for instance, $100, we move $200, you got yourself a problem. And then it happens again. But volatility, it just doesn't seem right for the type of price action that we're seeing. And I'll give you a perfect example this week. This entire week, and this is only a 4-day trading week, the expected move for the entire 4-day trading week is plus or minus roughly $120. We almost hit it already today. That's day one. You still got 3 days left in this week, okay? And yet we're hitting it right off the bat. Now, to the option market, I mean, there's literally billions and billions of dollars being traded on this option market, okay? The expected move is not like some fictitious beast. I mean, it's literal. It's billions of dollars being traded. The bothersome part is in a situation like this where there is a glut of shorter duration premium selling going on and the market continues to breach, okay? The real issue and what is at issue is the volatility seems low. The skew looks inordinately low, like 121, okay? That's insanely low. The VVIX is also low. So it looks like we have a glut of premium sellers of very short duration premium, okay? They've been getting torn apart and they just keep coming back right now to sell more premium. If they were buying premium, volatility would actually go up. VVIX would go up. And it's just, that's not transpiring, okay? I'm going to give you just the short, version of this. I'm of the belief at this point that absolutely we could rally back for a couple of days, maybe even call it a few weeks of rallying, if you will. The risk right now is still, okay, very critically apparent to the downside. There's just not enough volatility. There's not enough hedging activity. The skew is not high enough. Okay, these factors, they do not fare well moving forward. This is and will catch a tremendous number of premium sellers in the short duration, okay, kind of with their pants down. And it's like people are selling premium thinking this is like the most wonderful thing ever to get ripped apart. I, okay, am absolutely unequivocally a premium seller. But at this point, let's keep it under control. I am actually selling back month premium where there's actually considerably more volatility and there's considerably more skew. Short duration premium sellers. When I say short duration, if you're selling any premium less than, let's say, a month to go to expiration, you're in trouble. It is crazy time out there, right? You got to understand premium sellers, okay? Keep it close to the vest. I was talking about it on this weekend's update, and I'm talking about again, right? Do not scale heavily at this point in time. We very well may need, okay, a wild and woolly 3 or even 4 sigma type move in the SPX to basically jostle volatility considerably higher, and then we go back into a period of contraction to shock the market volatility higher, shock skew back, okay, into a much more normalized range. Excuse me. It's this is really an unusual time, and we've been in volatility before where volatility, didn't necessarily rock to the upside. But what's unusual about it is I've been in volatile situations where we stayed inside of expected moves, not that we're having 2 sigma breaches. And yet, again, week in and week out, the expected move doesn't necessarily rock to the upside. I mean, you could legitimately say over a 4-day trading week, maybe the expected move shouldn't be 120. Maybe it should be more like 200 or 220. That's not the way the marketplace is pricing it. In the near term, volatility looks incredibly, incredibly low relative to some of the risk we're taking. If you're selling options further out, you're okay. Again, keep it close to the vest. Don't over allocate and keep your hedges on. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.